start off with two questions from, what their answers are for, Terrie and Cliff. And Terrie and Cliff wanted to know, I need to discuss how to use the custom spread tool, the profit and loss chart and power options, as it relates to married puts and using other income methods to pay for it. Second question is for the Straddle calculator. When I plug in my own symbol, the percent probability looks low, so what am I doing wrong? I bought a Straddle on NVIDIA. Short answer to the second question is nothing, but we'll discuss why. More info on that came in from Terrie earlier, and Terrie commented that you have a married put in place following the radioactive trading techniques that protect stock owned in case there's a severe downturn. It costs money, and you want to offset the cost, so you sell a short put. Well, we don't do that in the radioactive trading technique, actually. And then she goes on to say, how do you protect the short put, which at this time is naked? Do you create a bull put spread to limit the risk? That is likely the only way, but again, it's still not suggested. It's not one of the 12 income methods that's discussed in the blueprint. The goal on the long stock is to hold it for long term and appreciate dividends. Is there a better way? Well, that's why there's 12 different income methods discussed in the blueprint. None of those 12 are doing the bull put spread or really the naked put, except for in one exception, and that's income method number 7, which we won't get into. But let's take a look at what we're talking about here, and then, of course, get into the straddles as well. All right, so let me go ahead and change my screen. Okay, just making sure the view comes up. Fantastic. Okay, so I'm sorry. What we're looking at here is just your basic power options trial account. For those of you who just got started, I encourage you to take a look at the free quick start guide, flash tutorials, free webinars, and coaching sessions, the 4 steps that are outlined for you. Let's start with the married put. And Terrie, sorry about that. Terrie's comment related to the married put on, we have a married put position. What is the profit and loss chart, and how can I look at potential positions? Okay, well, let's take a look here. Here's eBay. Here's a potential position I might open today if I was opening a new married put. Winnebago is one we've used in the past month. I'm probably going to open that one soon. But in any case, let's just stick with eBay. Stock's at 36.20. If I was following the radioactive trading techniques, which I do, I'd open a July 38 put for a cost of $310. Now that would make my total cost basis about, I'm sorry, $338 at midpoint. That'd make my total cost basis about $39.85. But the risk is only $1.85, and that's Terrie's concern, is how do I pay for the risk? All right, well, let's take a look here. We'll go to the profit and loss chart. All right, there we go. Sorry about that. Give me 1 second. There we go. That's better. Okay, so here at the midpoint, we have a risk of only about 4% on this position. Stock trading at 36.20. We hold the 38 put. The risk is 158. That's what I have to cover, not the 310. With the radioactive trading techniques, in general, what I do is, and what we all do, following the rules in the blueprint, is we wait for the stock to move up. And you've heard me say that about 75 to 80% of the time, the stocks that I choose from that list do move up the 3 to 6% I'm expecting in the first 20 to 40 days. Why am I waiting instead of selling right now? It's because I don't want to sell the 38 call right now. I don't want to sell the 37 because that's too far below my cost basis. 38 call near term or even maybe a month out, it's going to have too small of a premium. But if I get the 5% movement, and the stock goes up to 37.50 or so, now I'm going to be able to get a much better premium on selling the higher strike call. I don't want to do it right now because I don't want to put myself in a position to lose. And Terrie is also concerned about the upside on the position as well with just selling the call. Let's take a look at a short term, maybe 14, 20 days at a time. Let's go to February 28th. Take a look at the 38 call. It's only worth about 27 cents. So with a risk of 160, that's only about 1/7 of the total risk. I usually want that to be about 1/3 to 1/2 when I sell a call. I want to be cutting down the risk by at least 1/3 to 1/2 with this first adjustment. Now's not the right time to do it. Did I take the risk down to 3.3%? Yes. But I capped my gain at 2.2%, and the risk is still high in the direction I originally thought the stock was going to go. This is not what I do. This is why we wait. Well, the argument is, well, if you're bullish anyway and you expect the stock to move up, why don't you just sell an out-of-the-money put 14 or 20 days out in time for a reasonable premium, say the 35 strike. Okay, well, the reason why we don't do that is obvious for two reasons. We're in it to protect our positions. To have a low-risk single-digit position that puts the odds in our favor to be successful long-term. When I sell the naked put, I'm going to end up likely increasing the margin requirement for the position. Because this long put, yes, this does sort of create a calendar put spread, but the long put I own can either only protect the stock or protect the put. Here I didn't solve the problem. I'm still at a 92% maximum risk, not the 4% or 5% I wanted to start off with. So is the answer to do a bull put spread. Try to keep most of this 50 cents, buy it cheaper out of the money put in that case. Let's go here to the 33, two strikes apart. Okay, so this would be a bull put spread between the 35 and the 33. Well, so we get 14 cents. Take in 50, pay out 14, we keep 36 cents, but we have to increase the risk by about 2 points for the monetary requirement of this bull put credit spread. Now my risk is doubled to the downside. If I wanted an 8.2% risk, I might as well have just bought the at-the-money put in that case and not even worried about trying to sell anything for a mere 30 cents a premium. 36 cents a premium in this case. That's not near the money I want to lower the risk. I'm better off waiting, following the rules in the blueprint, and if I don't like how income method number 1, just selling a call which is introduced in the sketch, looks like because it caps the upside, well, that's when I'd consider income method number 6. We don't use this as far as using the put options at all. We don't sell the puts. There's an income method number 7 that's done as a reaction to something, and income method number 8 sort of looks like a condor. So Terry, you can check that out in your blueprint. But no, we're not going to do something right away. We're going to get a better return and a better payout by following the rules, following the guidelines, waiting for the stock to go up, and then get the proper income in the proper structure as outlined for each of the individual income methods in the blueprint, what we call the SIGA model, which is your determining sort of marker of which income method you would use. SIGA stands for the current conditions. What are your expectations going forward now that the stock has moved one direction or another, your goals for the position, and that determines your action. SIGA model for each income method is outlined in the blueprint. So we don't advocate, Ernie wouldn't tell you to do it, I won't tell you to do it, Kurt wouldn't tell you to do it. Most radioactive traders I know don't do it. We don't involve selling the puts in this structure. We don't try to force an income method right away because it's better to wait, follow the rules in the blueprints in that direction. Now let's take another look. Let's go back to the portfolio. In this position, I've already adjusted. But real quick, this is following along with Terry's other ideas of which income methods, not income methods to use, but what methods do to start paying for the put. So we had Yandex originally at 42.29 with a 47 put bought at 8.25. Stock moved up as I expected. It's up 14.7%, but it was up about 4 or 5% in the first 20 days of the position. Then it continued to move up further. We have already adjusted this position, canceled all of the risk, and bulletproof it without selling any premium with a call or a put or anything along those lines. Let's take a look at the profit and loss chart real quick. So now that the stock has moved up and is trading above the put strike price, now would be the time that I'd consider doing an income method. Okay? And I could just sell the call if I wanted to. We could go out 10, 14 days, maybe 20, maybe 30 days. Probably take a look at the 50 strike. That's not quite $1. It's about $1. The maximum risk was a little bit higher. I'd probably go with the 49 in this case, $1.30, $1.45 to get that third of the initial risk I wanted to pay for. But I waited for the stock to move up. Now sure, hindsight's 20/20. You can go back and you can say, well, since the index moved up, what was the harm in selling a put at one point? What was the harm in doing a bull put spread? The harm is in the case like another married put I'm in ON, which dropped 15%, and I'm only at a loss of about 4%. Had I had the bull put, it'd be a loss of about 8 or 9%. Okay, so I'm going in the wrong direction in that case. One would have worked and I would have gotten 30, 40, or 50 cents. The other would have increased the risk by 4 or 5 points. Not what I wanted to do. So in any case, you could sell the call here. You just add it in, sell the call. Oh, sorry about that. All right, so there we go here. Okay, so now what have I done? I've lowered the risk, not quite by half, but by a third. I've still got a max 10% profit on the position if it's trading right at the strike prices, okay? Okay, all right. Sorry, just take a look at something. Okay, sorry, there's a lot of comments coming in and questions. I'm just making sure they're not related to this, okay? Yeah, and Sam comments here, this is what I was looking for, comments on this. Terry, in relation to your question, regarding to the idea of selling, Sam says you must only sell a call above the resistance level, otherwise you'll burn your money. So yeah, no, that's exactly right. So, but again, one of the other income methods is if I want to leave the upside open, I could still sell this call, but buy another call, and that would leave the upside open, okay? That's the way that you could do it in that case. That's another income method. That's income method number 6. So that's what we're looking at here for using this for the positions that match your criteria. What I actually did, because earnings are coming up in 5 days, this was a January put that I already paid the money for far out in time. And what I actually did is I sold this put a few days ago for $5.50. I think it was $5.50. It was either $5.60 or $5.50. And then I decided to use a May option, which was still 100, 101 days out in time. Bought the 50. And that was 410 or 420. I can't remember the time. I think it was maybe, let's try 420. Something close to that. So what am I doing here? I'm actually getting a credit. Yes, I paid $8.25. I'm selling it for $5.50, so you can say, yeah, you lost $2.75 on that put. Yeah, but I've gained over 6 points on the stock. And I'm taking, right now, this was already factored into the original cost, I'm generating a credit of $1.30, more than that short-term, just equal to that short-term premium, but I'm increasing my payout by 3 points. This was an income method number 4 with a 3 twist, and we've got a no-risk position going into earnings where right now my profit is still around 7 or 8% if I liquidated, but if the stock spikes and goes up 10, 15%, I still get more of that upside. If it drops 10, 15%, I'm still bulletproof on the position. Without selling, without forcing generating premium that's not one of the 12 income methods that would actually increase the risk to the downside, we are able to bulletproof the position, following the rules, still have unlimited upside profit potential in this case, no fear in earnings. It's a fantastic place to be. Okay, so that's how we use this tool. And related to your other questions, Terry, that's why we don't use naked put positions in conjunction with the married put structure in the radioactive trading, nor do we use bull puts by themselves when you're opening the position and trying to force that income method, even though your goal you set is long-term to collect dividends. If you've bulletproofed the position and it doesn't add to the risk, it adds to the risk, but it doesn't take you out of bulletproof status, you might consider that, but I wouldn't do it right away because you're going to end up taking your risk from 4 or 5% up to 9, 10, 11, 12% by adding the bull put, and you get 1 or 2 of those that go against you in the first 10 or 15 days from something that you couldn't see in the stock chart, bad news came out, or a correction comes out, you're on the wrong side of where we want to be. We want to be in the single-digit risk, not the double-digit risk when you're using the structure conservatively. So that's the best way I can answer your questions about how to use the tool to evaluate the income methods and adjustments, and why we don't use that naked put right away. Why we don't use the naked put period in the radioactive trading techniques, and why we don't use the bull put spread as well. You want to follow the rules in the blueprint. You want to wait for the proper time to do your income methods. Follow those guidelines and the Siegel model that's discussed for each of the 12 income methods that's there as well. Now, related to your straddle question, Terry's been working with Ernie had a couple coaching sessions with him regarding what he's setting up and what he's working on with these earnings straddles you hear me mention, and his product that he's developing for earnings straddles. But Terrie had commented that when she sets up her long straddles, when she's looking for her long straddles in the calculator tool or setting it up in the search by symbol tool, she's getting a very low probability. What is she doing wrong? Well, let's talk about that. Let's go to long straddle and let's go into the search. What we show on the straddles is the probability sum. This is the sum of the theoretical probabilities that the underlying stock will move above the upper break-even or below the lower break-even for the straddle, the V-shaped profit and long chart. Yes, when you're buying a long straddle, you want to look for a higher probability number. You're never going to see anything in the 60, 70, 80% range. Okay, that just doesn't happen. The prices of these options, you see we've got the earnings dates here, 5 days away for Kinross Gold, 7 days to expiration for the February 14th cycle, naturally, and a debit of 46 cents to get into the 4.5 strike with the stock trading at 493. All right, so this has a high probability sum of 45.50, meaning that based on the past movement of the stock, it's got about a 50-50 shot of going a little bit less than 50-50, but going above 496 or dropping below 404 to realize a profit. And as you see, a couple of these lower price stocks have that higher value. But as we start getting into higher stocks, we start dropping down the 20s. Goodyear Tires got only about a 14% probability. This is around what you expect because these options are inflated because earnings is coming up. So there is going to be a low probability sum. What Ernie means by a high number here, what the definition means by a high number is something above 15% or so is what you're kind of looking for, because in general, you're not going to have a lot. Now, case in point, we'll go to the search by symbol tool. We'll go to NVIDIA, and we'll go to February 14th. I'm just going to leave it at less results right now. So we're buying a call, buying a put, essentially at the money in this case. The stock's at 251.59. I could choose to buy the 252 strikes, call and put, to be a net debit of around 1693, making my upper break-even 269.42, my lower break-even 235.58. There's only an 8.4% probability that NVIDIA will be trading above 269 or below 235 in the next 6 or 7 days at expiration. Earnings are 6 days away. The earnings is 7 days away. Now, does that make sense? Yeah, it kind of does, doesn't it? It's a fairly significant move of 17 points on a stock that, yes, earnings are coming up, and the average implied volatility, the SIV here on the stock research tool, is at 0.45, 0.44. But the average 50-day volatility and 20-day volatility is only 0.32. So the probability equation is saying that in general, this stock doesn't have a tendency to move 17 points in 7 days. It's probably done it in the past, but in general, it's much more gradual. There's a lower probability. But that's based on past movement, Terrie. I don't want to say throw the probability out the window, but what you're betting on with an earnings straddle is the unexpected. That yes, a 10% move, 20 to 25 points on NVIDIA, would put you well into the profit range. 9-point profit on a 16-point investment. If it moved up 25 points, put goes to 0, calls goes to $25, where it is right now. Falls, drops down in price. You paid $16, $17 to get in. Drops 10%, drops 25 points. What happens? Call goes to 0. Your put's worth 25 points. You make $8 or $9 on the $16, $17 investment. The lower probability sum means that the stock doesn't tend to move very often, doesn't have wild swings. But you're going into earnings with a plan that you're expecting the wild swing. So again, I'm not saying throw probability out the window, but that's why the NVIDIA probabilities are low, because it has, in general, a lower volatility compared to Let's throw some out there, Sam. Tesla, anything like that that has a much higher volatility and a much higher swing movement all over the place as well. Okay, so that's sort of what we're looking at here in this scenario, is that you kind of just have to throw that out there as well. Now, Sam's doing something different. You've heard him mention that before. Sam's doing straddles that are farther out in time, 2 to 3 months, and he's playing them up and down as they move up and down. This is talking about straight earnings straddles going shortest term with the closest expiration beyond when the earnings date is released. That's what Terry was discussing with Ernie, so that's where the conversation came from. On this note, Fernando says, in a straddle, do you agree in buy and sell underline and keep the structure delta neutral to fight the theta decay? No, that's not what we're talking about at all. We're talking about straight lottery ticket straddles going around earnings, trying to find positions that have a low percentage net debit against the underlying stock price. I'm sorry, that should have kept that up there. There it is. I mean, this one does have a low percent net debit. That cost 1693, 1673. We're only at 6-7%, 7%, let's call it, of the underlying stock price, meaning a 7% movement would get us probably to the upper, will get us to the upper lower break even. A 10% move would get us into the profit range we want of roughly 40-50% or so on the position. So this is a different kind of structure. And the idea of using a straddle, Fernando, and is to profit on the movement of a higher price position. If we're doing it maybe going 2 to 3 months out in time, we're trying to profit on a position that we expect to move up and down. We're looking at a V-shaped profit and loss chart for buying a call and buying a put. Of course, there's a wider swing here in either direction. That's what we need, but that's why this is done around earnings. As Sam mentioned, you've got an SPY, a QQQ. You buy 2 to 3 months to give your stock more time to move. So if the stock goes down, you can adjust it. You can sell premium against it. Might sell a call if it hits, the upper level, as Sam mentioned, and starts to pull back in that case. But you're doing it to use leverage. So you can do what you're saying, Fernando, which is as it's going in your direction or going against you, you can buy the stock, buy the underlying, short the underlying to help hedge it. But in general, people who are trading with straddles and strangles are trying to avoid that cost to buy the stock. They're trying to play the stock with leverage, with controlled leverage. So this doesn't represent more than maybe 3-4% of their total portfolio. They're not looking to the buy stock and do it that way. If they wanted to buy the underlying directly to do a covered call or a collar, they just would have started that off to begin with to keep the risk low, in my opinion.